Welcome to our webinar on how and why you should invest in gold, in brackets, and silver and platinum. I've got some wonderful experts with me here, and I'm delighted to be joined by them. They are people who can answer pretty much any question you throw at them. The webinar is being sponsored by the Royal Mint, and we are honoured to have Andrew Dickey with us, who is the Divisional Director of Precious Metals at the Royal Mint. We also have John Butler, an economic historian and author of, and I'm going to hold it up, The Golden Revolution and The Golden Revolution Revisited. I've got a copy. You can get one too. And we also have Charlie Morris. Charlie, give us a wave. Who is Chief Investment Officer at ByteTree Asset Management and is best known for his expertise in alternative assets, notably gold and Bitcoin, interestingly, two alternative assets that I'm particularly interested in as well. So if you want to know about investing in the money metals, you've come to the right place. Now, I'm going to get the ball rolling with a few questions of my own, and then I will just open it to the floor. And my glamorous assistant, Izzy, will be watching for your hands up. So firstly, I'll start with you, Andy. Let's get down to basics, shall we? Firstly, from the Royal Mint, how do you buy actual physical gold? And is actual physical gold that you can touch and feel with your hands, is that the best way, honestly, to invest in gold?
Evening, Jasmine. So the answer to that is you can buy gold, silver, or platinum in any form that you really require. It's whatever suits your individual tastes and personal situations. We at the Royal Mint have a range of products. Yes, the bulk of our business is in physical bullion, the selling of physical metal and either storing that in the Royal Mint vault or sending it out to customers. We also have a range of physically backed digital products. So there is physical gold and silver and platinum bars at the Royal Mint vault that customers can take ownership of gradually through monthly investments. And then there's our London Stock Exchange listed product, which is available on the ticker symbol RMAU. So you can buy gold in any form that you require, really, to suit your personal tastes and needs.
And when you say you can have it sent to you, so I could buy sovereigns from you, because I know you've got an amazing range of coins with amazing things on them. If I actually bought some over online, how do I know it's going to be sent to me safely? How do I know I'm going to get it?
Yeah, so we work with a series of approved couriers. Everything goes out fully insured. I should also say that for orders over a certain value, the Royal Mint security team actually hand deliver packages to valued customers. So if you wanted to speak to one of our account management team, the telephone number is all over the website. All you've got to do is pick up the phone and arrange to have delivery of your bullion, your gold sovereigns or your Britannias. Or your bars. Our Royal Mint team will come out and deliver that to you in person. And
now, you mentioned your digital product, because gold is what it was, a bit under £1,400 per ounce. I think 1,300 and something.
Yeah, 1,340 roughly. Yeah, especially over COVID, because we've welcomed in so many new customers during the uncertain period that COVID has created. What we've tried to do is to broaden out the range of products available to suit all budgetary kind of requirements. So we've had a lot of new customers coming in looking to invest in precious metals and looking to access those investments at lower entry levels. So we've got a range of fractional gold coins. So as an example, you can buy a 1 gram gold bar for £64, and we have a 1/10 of an ounce Britannia, beautiful Britannia coin that starts at £160. But one of our fastest growing products is DigiGold and DigiSilver and DigiPlatinum. So that is basically a means by which you can gradually accumulate ownership of gold bars for as little as £25 per month. So there really is a way of accessing precious metal investments at any budgetary level, really.
Oh, that's interesting. Now, John, would you say that gold has become a lot more popular with investors? Why is that, do you feel?
Well, I think there are many reasons why gold has become more popular. I mean, and some of these go back a number of years. I mean, we all remember the financial crisis of 2008, and that made a lot of people worry about the safety of just ordinary, currency, as it were. I mean, as an economic historian, I can point to a large number of historical episodes when currencies failed to hold their value, failed to protect wealth, and in some cases collapsed entirely. Now, I'm hardly predicting anything like that, but when you have a major financial crisis, naturally, it makes people sort of wonder, where did that come from, and is that somehow related in some ways to other financial crises historically? And owning gold, regardless of whether you expect some sort of financial crisis, inflation, devaluation, whatever it might be, is simply good financial sense. It's kind of like an insurance policy. If you own a home, you insure the home. Even if you're not sure when a fire might start, even if you're not sure when you might be burgled, even if you're not sure if you ever will be, you still purchase insurance. It's basic common sense. Adding gold to a financial portfolio that is typically stocks and bonds, right? Perhaps some other alternative assets, is just financial common sense. It's a form of diversification, safety, security, insurance. Everybody should own some. The question is how much and in what form.
So what percentage do you think people should have in their portfolio? 10%, 5%, 50% gold? What do you think at the moment?
Well, look, there are multiple ways to approach this. And one way that I've used for many years is simply, again, if you're trying to understand the value of gold as insurance rather than timing the market or trading or speculating or whatever, but you just see it as something that should be a core part of a sensible, diversified, conservative portfolio, just take a long look at history and take available data on the financial performance of stocks, bonds, property, cash, and gold. And you can run the numbers just as they are. Take the numbers. They go back to the 19th century. You can get a good data set over 100 years. And when you run the numbers and you solve for what is kind of the base amount of gold you want to most efficiently diversify and protect a portfolio of financial assets, it comes in the range of 10 to 20%. And the reason why I give a large range is because it really does depend on the type of financial environment that you are in. 10% pertained more or less during the period of the gold standard when money itself was linked to gold, so you didn't need as much gold in a portfolio to replicate its effects. But ever since we left the gold standard in the 1970s, the amount you want rises, and it rises considerably if you still want to benefit from the diversifying insurance characteristics of gold. So 15 to 20% is the level that I recommend to most people today.
Great. And Charlie, I mean, I'm guessing you would agree. You are a big fan of both gold and Bitcoin. Interestingly, I was talking to a friend of mine who works for a fund platform, and he said he's very bearish about gold. He's also very bearish, he says, about Bitcoin. So you two would have an interesting conversation. I'm guessing that you're pretty bullish still about gold, are you?
Yeah, well, I think that, everything goes up and down. So I'm sure your friend will be right for a moment. But, my view is that over the long term, gold only goes up. And it might take a year off. It might take 10 years off. In fact, it took the 80s and 90s off in dollar terms. But, if you measured it in Turkish lira, Indian rupees, what have you, it rarely takes a year off. Gold's always at an all-time high somewhere. And so, as John was saying, it's the insurance policy. What if the money of your country goes wrong? That's why you own it. And yeah, it absolutely makes sense. I mean, your institutional investor friend should understand portfolio dynamics. And if you add something to a portfolio that's different, then that changes the characteristic and often reduces risk. So if you can cover off an economic scenario that, let's face it, is not really covered off by many other things. The only other thing that does the job of gold is inflation-linked bonds, and they've got government risk. And let's face it, as John was saying, maybe it's the government that's the problem. And to quote Ronald Reagan. And So you've got this sort of timeless investment, and most portfolio analyses would say 8% makes the portfolio better. But then to 8% weight in a sort of balanced portfolio of 60 equity, 40 bonds. But in this day and age, you'd be a bit crazy to own bonds because there's no point because they don't yield anything. And so you would increase that number, and you would probably look for more alternatives.
So would you also add in silver and platinum, or do you think really gold is the only one worth going? Because silver's done some very interesting things over the last year or so.
Yeah, so basically, if you're a grown-up and responsible individual, then you'd own gold. But if you like the idea of gold, say I want a bit more juice, then let's have some silver and some platinum. So but you have to remember, the more silver you add, the more irresponsible you're being. Now, I mean, I joke because actually silver's got a grand history, just like gold has. It's been part of the formal monetary system and all the rest of it. And right now, it's a little bit cheaper than you'd expect it to be against gold. Platinum's a lot cheaper than you expect it to be on a 30-year average. But platinum's got no driver because the industrial use is really diesel, and no one likes diesel anymore. But if hydrogen takes off, then maybe platinum comes back because you need some platinum to make hydrogen, and hydrogen's all lovely and ESG and that sort of thing. The two portfolios that I look after in the Fleet Street letter, in the solar portfolio, which is the low, medium, long-term risk portfolio, we invest in gold.
Oh, cool.
And in whiskey, which is the more interesting portfolio, more dynamic, more volatile portfolio, we don't have any gold, but we have gold miners, we have silver, and we have platinum. So, what kind of investor are you? And then choose your poison.
Jasmine, can I just jump in there and just say from our point of view, we see a different age demographic across the different metals, interestingly enough. Going in with what Charlie was saying there, silver, because it's a lower access price and it's a little bit more volatile, seems to be far more popular with younger investors. So the millennials have really come in for silver this year. We had the Reddit phenomenon at the start of the year as well, so partly fueled by that. So it's fascinating watching the different types of customers coming in for different reasons on each of the metals.
Yeah, that is, because I was going to mention Reddit, because I have read on Reddit and a few places that the silver price has been manipulated. Have you any of you heard that? Or do you think that's just Reddit being silly?
Have I heard that? It's been a rumor in the market for as long as I've been following it, which is 25 years. And there's an organization called GATA, the Gold Antitrust Action something. And they believe that JP Morgan is permanently short. Now, the people at the core of the gold market who shall remain nameless, when you put these questions to them, they don't bother answering them because they say they've answered it hundreds of times before. They say there are no naked short positions. Yes, JP Morgan have large short positions, but that's balanced against client orders, which are long, and so there's a balance. So basically, if you're an investment bank trading desk and you sell loads of metal, then you want to get rid of price risk overnight because your client wants the price view, but you don't. So you go the other way with the futures contract. So that's what the banks would say, but the conspiracy theorists believe that they're naked short.
Charlie's absolutely correct, but again, the same way in which I mentioned, if you own a home, you want to insure the home, even if you don't expect a fire, even if you don't expect an earthquake, flood, tornado, whatever it is, and it's just common sense, and it's a conservative approach. Look, the fact is, financial markets, banks, what do they represent? They represent largely intangible assets. Those assets may be theoretical claims on something tangible and the wealth it produces over time, but the form it takes becomes increasingly intangible. This is especially true in the age of derivatives that we've been in now for some decades. And so even if you don't think there is any fraud going on in financial markets, even if you don't think anything is manipulated, even if you have no reason to believe it, gold and precious metals generally still function as a form of insurance against those kinds of risks because they can be held in physical form. And most financial assets simply cannot have that characteristic, no matter how much you might like it.
Absolutely. And, I think this is why I was asking about physical gold, because there is something for a lot of people about actually having something in their hands that they know has some value. That I think is why in this country we like to invest in property. But are there tax advantages as well to owning sovereigns? Am I right in thinking there's some tax advantage to the physical gold?
Yeah, so our sovereigns and our Britannias are classed as legal tender here in the UK. So they are capital gains tax exempt, and the gold coin is also VAT free as well, Jasmine. So that is obviously a considerable motivation to owning gold here in the UK.
Now, questions. We've got a lot of people here. Surely some of you have your own questions. Would anybody like to ask anything particular? Because you've got three really experts here. Seriously, it's not often that you get these people in one room. So does anybody have a particular question they'd like to ask about investing in gold? If you don't, I will continue because I have quite a few questions. Okay, so this is Rafael. Nice, thank you. Good to hear from you. Now, watching past gold price go between 1980 and 2000, that 20 years gold price stayed at the same. Oops, sorry, it's just same level. Even goes a bit lower. So, how is it a good idea to invest in gold? John, I'm going to start with you on that one.
Well, the way gold's price behaves is largely a response to the general macroeconomic environment and, of course, expectations thereof going forward. And following the, some would argue, disastrous stagflation of the 1970s, when the price of gold absolutely soared from $42 an ounce to over $800 briefly, it then did settle lower for a long period of time. But the reason that was the case is because there was a very, very significant change in economic policy, not only in the United States, but in many other countries, to raise interest rates, to increase savings rates, to reduce borrowing rates. And that had a generally negative impact on the gold price. But think now what that means. It means that as those 80s and 90s years went on, other financial assets performed comparatively well. So in a long-term conservative diversified portfolio, you want to be allocated efficiently to those assets that do well in a stagflationary environment, as well as those assets that do well in a non-stagflationary, more healthy growth environment, such as the 80s and 90s more or less were. And so really you need to take the whole sample into account. Don't get me wrong. If you think you can time business cycles, if you think you can time major policy shifts by governments and central banks and can trade gold actively based on that sort of information, good luck to you. But if you simply want to own a conservative, sensible, diversified portfolio, you must also pay attention to the historical periods when gold outperforms both stocks and bonds, also property, and sometimes by a significant margin.
So it is really diversification. Charlie, do you feel that we are in a stagflationary environment now, or maybe coming into one? So gold will have it come into its own?
So yeah, absolutely. John made the point very well. I mean, the question was, why did gold go down in the 80s and 90s? Well, it went down, having gone up 27 times in the 70s. Yeah, when everything else went down. So bonds went down, stocks went down, cash on deposit went down because inflation exceeded interest rates. Now we're back in that, to your question, Jasmine, we're back into one of those eras where the inflation's up there and the interest rate what is that? I remember the good old days. When I was a child, it was 10% is what we got in the bank. Now, you're lucky to get 1 if you're on some special bonus deal. So yeah, absolutely a good environment for gold. But let's not forget, gold did extremely well between 2018 and 2020. So it's having a rest following that surge in performance that we saw over the last few years. Now, the last year, gold hasn't done much, but it's just resting. It has an 18-month rest every now and then it wakes up and off it goes. But you have some, as John says, you have some. It's insurance and it's tax efficient, as the Royal Mint have told us. If you make sure you own the right ones. Don't own South African ones or Chinese ones or Canadian ones. Make sure you own the British ones as described for your tax advantage. But yeah, absolutely, have some.
That's great. Now we have Francesca. Now, Francesca would like to buy physical gold, but she says, should I buy and store them at home or elsewhere? She feels like a silly question. No, it's not. That's a really good question.
No, it's the question that has to be answered when you've made the decision to buy gold is do you take ownership of it, or do you trust somebody else to store it on your behalf? It's the big question, really. Sorry, Charlie, were you going to say something there?
I was just going to say, what you don't do is ask the question on the internet and tell the world you're thinking about storing gold coins at home.
Yeah. All I would say on that, Jasmine, is you can do either, and it has to be your own choice. We have, I would say it's almost a 50-50 split. Some customers really want to take delivery of their bullion. You know, for some, gold is that insurance that John's been talking about. And in order to really feel that insurance, they want it as close to them as possible, and they want to store it themselves. I would say the other 50% of our customer base choose to buy the gold. So they actually own the physical Britannia, and then they choose to place it into our vault. So it sits there in the vault at the Royal Mint, outside of the financial system, protected 24 hours a day. And it's all labeled up, and you can actually, you know, it's there, and it's your legal product. And when you choose to take delivery of it, we will remove it from the vault and send it out to you, or you can sell it back to the Royal Mint. So either way, you know, there are pros and cons to both approaches.
Cost is one of the pros and cons, I would say, because how much does it cost to store it with you? And then, of course, if you hold it yourself, you have to think about buying a safe maybe, or and the insurance and all of that. So first of all, what's the cost for you? So
if you're choosing to buy a physical product and then actually have it placed in the vault on your behalf, we charge 1% of the value of the product that is in the vault, which is lower than most asset management fund fees anyway. And it sits there, you have peace of mind, and we hold it on your behalf. You can also go through our DigiGold product, which is a way of gradually accumulating gold ownership. You legally own part of the gold that is stored on your behalf in big 400-ounce bars at the Royal Mint Vault. And the storage fee on that is slightly lower at 0.5%. So those are the two kind of fee structures that the Royal Mint offer.
Because my understanding is that if you have it yourself, you could either, do what a friend of mine, and I'm not going to say who, does, and actually put it in your sock drawer, just not tell anybody, or you could have a safe at home, or you could get one of those safe boxes at your bank. But again,
I think as Charlie said, the biggest security feature is secrecy. But after that, really, it is your choice. You take that risk on, and you either invest in some form of home storage solution, or you take it and you place it in some other storage facility.
Now, Kerry's saying, can you elaborate on when you say don't buy South African Chinese? What do you mean? So, Charlie, elaborate for Kerry, please.
Yeah, I'm not legally allowed to give tax advice, but there are many different pretty coins out there. So if you go into a bullion dealer, you can buy one with a picture of a panda on it, and that's obviously Chinese. You can buy Krugerrand from the film with Mel Gibson in it. That's a South African one. There's the Austrian ones and the Canadian ones. So there are lots and lots of, for historic reasons, the American Eagles and so forth. And they're all pretty, and you can get into collecting, but you only get the tax advantage as a UK citizen, and this is not tax advice, if you buy Royal Mint coins, which are the Britannias and Sovereigns, which I think Andrew could confirm.
And isn't that because they are, in theory at least, legal tender? They're sort of considered coins, like your 50p piece, that sort of thing?
That's correct. Yeah. So they're struck with the Queen's head. They are classed as legal tender, and for that reason, they are capital gains tax exempt. But as Charlie says, it's the UK bullion coins.
All right, excellent. Thank you. That good question there, Kerry, because not everybody realizes, and it's a little extra, I think, to know about gold. Now, Morgan, how quickly does the selling back to the mint take? That's a good question. Just wondering how locked in you would be if you need some of the money in an emergency or something. So, Andy.
Yeah, so almost immediately, if you have chosen to leave your gold at the Royal Mint Vault, or you are investing through DigiGold, and slightly longer if you physically own the bullion at home. You would basically send it, you would speak to somebody at the Royal Mint, you would then send it into us or bring it into us. We would assay it or authenticate it, and then we would then offer you a price for that gold and execute the transaction. So slightly slower process if you physically own the gold at home, but you would expect that because, you know, we'll need to take delivery of the gold back, and almost immediately if the metal is stored at the Royal Mint Vault.
Great. Claire says, is there a low-cost gold tracker fund that you would recommend, or is physical gold a better way to go into provide a portfolio diversification? Charlie, any thoughts on that?
Yeah, I'm not on mute. There are lots of ways to own gold. I mean, the advantage of buying the Royal Mint coins is if you're a really long-term investor, you're not going to trade. So if you want to own it for 50 years or 20 years or whatever, and you don't care about trading because they're not cheap to trade, the bid-offer spread is quite wide. So that's probably the best way to do it. But if you do want to be able to trade, then you can go to one of the bullion companies. There's Bullion Vault would be a good one, and there's Gold Money as well, and there are several others as well. That's a cheap way of just having vaulted gold, but you lose the tax advantage that he mentioned. Now, the other way you can do it is if it's in your pension fund, like your SIP, yeah, or your ISA, not your pension fund, but a SIP or an ISA, where you've got the tax advantage there, then you could buy an ETF. Now, some people think ETFs are fake gold, but I think they're real gold. They are real gold, but they just own it over the stock market. They're cheap to trade, and I think the good ones are less than 0.3%. I know there's one in Switzerland run by iShares.
Yeah, I should jump in there and say, obviously, that we've got one as well. And the metal that you can, the gold that you can buy through our ETC is physically backed. So it works a bit like DigiGold, but it's available through the London Stock Exchange. I think we're on the Italian Stock Exchange as well, and the German Stock Exchange, and soon to be on others in Europe. But the ticker symbol is RMAU, so Royal Mint Gold. And it enables you to really easily and quickly invest in the value of the gold that is stored as 400-ounce bars at the Royal Mint. There are plenty of gold ETCs out there, but we like to think that ours stands above the rest. They're all 2019 good delivery bars, as authenticated by the LBMA. And obviously the vault at the Royal Mint sits outside of the financial system. So it just offers you that added bit of safety and security.
And Andy, could you explain again, what is an ETF and what is an ETC?
Jasmine, that is a fantastic question. I don't even know myself. I think they have exchange traded commodity, exchange traded fund. We call ours an ETC because gold is a commodity. Charlie, please feel free to enlighten me further.
Yeah, I mean, it's a bit of history here. The ETF is the word fund, and that started off in equities because the legal structure is the same as a normal equity fund that you used to buy, like a unit trust or whatever. I actually call it a UCITS fund, but who cares about that? So the legal structure for an equity ETF is exactly the same as an equity fund run by an active manager. Now, the legal structure for one that uses a commodity is slightly different. It's not technically a fund, it's technically a note. So it's a kind of more of a fixed income instrument. So you put the gold over there with a sort of promise that it's owned by the shares without getting overly technical, but it's a slightly different structure. So you usually say an ETC, exchange traded commodity, or an ETP, exchange traded product, to have a non-equity, to describe a non-equity or bond exchange traded fund.
Because I'm a fan of ETFs, you know, I mean, I like them because they're cheap. However, I have heard that with some gold ETFs, and just to explain, you know, ETFs, they're cheap funds and they tend to track things. You know, you can track an index like the FTSE 100, or you could track gold. And I've heard that some ETFs don't really have the gold underneath them that they say they have. Have you come across some of those, Charlie?
Well, no, there are no gold ETFs that don't have the gold they say they do. If that were the case, then it would have been a big fraud. It would have been uncovered. So that is not the case. Now, there can be a difference of return. So there have been some gold futures ETFs, which is not quite the same thing. Yeah. They've kind of gone out of business because they've all been replaced by, spot gold ETFs with, as Andy says, this, and John, we all like the real stuff in a vault. So that the market has won that argument. But there have been some gold futures, which is a financial contract. And those things exist in other areas, like, so if you buy one for copper or you buy one for oil or some other commodity, you're likely to get a futures thing. And then the difference between your return and the actual commodity return will be quite big over time. So, you don't really want these things, but they're great for short-term trading. They're terrible as a long-term investment, basically.
Well, we've got another question here from Alex, who says, what's the best place to invest in gold? Well, Royal Mint. And is it just via the stock exchange? And if so, does it matter which account if the interest rates are the same? I'm with Fidelity, and I know they have a global gold portfolio, stock exchange linked. Okay, so we're looking at sort of actual gold funds here. John, do you have a view of the best way or the best place to invest in gold funds? I'm guessing, most of the platforms are pretty similar. As you mentioned, Fidelity, there's also AJ Bell, various of those.
Yes, as has already been mentioned, there are a number of ETFs, or call them ETCs if you prefer, out there. And any reputable broker in this investment manager in this country is going to enable access to one or more of those. And as Charlie has said, the bad ones don't really exist anymore. The ones that are still around are generally reliable and have varying fees and whatnot depending on precisely what they provide. And I'm speaking strictly about those that replicate a position and hopefully have an actual position in physical metal. I'm not talking about miners or other companies that are active in the gold value chain, as it were, but the actual bullion, the actual coins, the actual metal itself. So I suspect essentially all of the major names in this country will have at least a handful of relevant ETFs, ETCs, and so on that will meet the criteria that those of us on this call would think are robust criteria.
Yeah, and I think when it comes to the platforms, as John says, it kind of depends how much you trade, which are the best ones, and they most of them have different packages. So it depends. If you trade a lot, you'd want to go for one that gives a low monthly fee. If you trade only occasionally, it's best to go with ones that just charge per trade. There's, of course, Fidelity, AJU Invest, there's Interactive Investor, Charles Stanley, Hargreaves Lansdown, which I think is a bit more expensive, but yeah, there are various to choose from. Now we have another question from Sushila, I think it is. Do you have, now this is more about the miners, I think, do you have any views on the benefits or otherwise of holding shares in companies such as Kinross Gold, Pan American, Silver Core, First Majestic, Silver Core, instead of the physical metals? Thank you. Charlie, what do you think about investing in these as opposed to the metals?
Well, in the bull market, you'll make more money. It's simple as that. But if the bull market doesn't come about, you'll lose more money. So it's simply a question of financial gearing. So you could when you're buying a gold mining stock, you're trying to look for how do I put it in without sounding like a financial plonker? If you look, there's this word called alpha, which is a little bit of magic. Mm-hmm. So if let's say I buy £100 worth of gold. Now, if I borrow £90 to buy £100 worth of gold, then I've got a really hot investment because I've only put 10 in, and the price of gold is moving around. So I've got a highly geared investment. So I could make 10 times. If gold doubles, I can make 10 times my money, right? My £10 goes to. And so, are you just getting gearing in a gold miner, or actually are you getting value add? So you're looking for a good miner that's going to grow production, who's got its costs under control, and all that sort of thing. So, that's really hard. I've basically, in all the years, not really found any analysts who are very good at finding good gold mining stocks. It's actually surprisingly difficult. There's so much execution risk. And of course, things like some of the problems for gold miners will be regulatory, but also you've got the energy costs. So if the oil price goes up, it's a big component of what they do is drive trucks around. and so that's a real issue. But yeah, absolutely. Own some miners, own some silver, own some platinum, own some gold. I mean, get in there and have some fun.
A good mix, basically.
A good mix, yeah, absolutely.
Because one of the problems I hear about miners is that quite often you've got a political risk as well, because quite often the mines are in countries that have not the best governments, basically. So do you find that's an issue?
Unlike our fantastic government.
Yeah, fabulous government.
Yeah. So yeah, that could be an issue, but just diversify that away. And you say you have one in Mexico and one in Russia and one in Egypt, and once you've gone through that exercise, then actually you've diversified, which is the whole point of that exercise. Is diversification. Diversification, as they say, is the only free lunch in investing.
Yes, absolutely. Now, Alex says, what's the best place to invest in gold? Is it just via, oh no, sorry, that was just the same one. Sorry. Now, this is Li Chen. Can you please explain why Royal Mint Gold is more expensive, than that of the other dealers? Is it, Andy? This is from Li Chen.
It's not always more expensive, Jasmine. I think we just talked through DigiGold. You can own portions. And I saw another question come through. Do you legally own the gold through the digital gold product? So with DigiGold, DigiSilver and DigiPlatinum, yes. If you spend £25, you legally own £25 of the 400-ounce gold bars that sit in the Royal Mint vault. That is yours, and you legally own that, and you can sell back as and when you so wish. I think the answer to the other question is that the Royal Mint is the original crafter and authenticator of precious metals. We've been dealing and working with precious metals for our 1100-year history. A great example is the recent Lakshmi 20-gram gold bar that we designed internally at the Royal Mint. We worked with representatives of Cardiff Hindu Temple to ensure that the design was authentic to the Hindu faith. And we released it in time for Diwali. And that was designed and crafted and struck on the premise of the Royal Mint by our fantastic team. And it's been a huge success on the lead up to Diwali. And so, yes, there is a manufacturing premium that is built onto these products because of all of the craftsmanship that goes into these beautiful, iconic products.
I'm just thinking, you're mentioning Diwali, and of course in India, gold is a very important metal. When you get married, you're given gold. Gold is very fundamental. Same with the Middle East, Russia, gold. I mean, John, do you think that because globally gold is so important to so many people, that kind of gives it the solidity that many investors are looking for the next, I don't know, however many years?
Well, I mean, it's worth asking the question, why has gold been essentially universally valued throughout history? It cuts across cultures, it cuts across time. The only possible way to explain it is there's simply something in human nature which may never be explicable in a thorough scientific way, that gold retains that value, which borders on the religious in many cultures. That is not going away. We in the modern Western world, surrounded by technologies we increasingly don't understand, but we use and we admire, and we make the world more convenient for us. Well, that includes our monetary and financial systems to some extent. Most people have no idea how they work anymore. Mm-hmm. And the fact is that there is something just fundamentally appealing and reassuring about this physical metal that people have always and everywhere desired. That is not going to change. So we may, again, be distracted in a certain sense by the modern world. But one of the benefits of owning gold is that even if, for whatever reason, people in your country, your town, your neck of the woods aren't interested in buying your gold off you at a fair price, if you're in some need, a personal, household, business emergency, the world at large will. There's always a price. And that price is, and there's always a market, and that market is always extremely liquid. Even in the deep depths of the financial crisis of 2008, when there was a complete seizing up of trading of stocks and bonds, the gold market ticked over as normal. And that should tell you something.
And is it the case that places, I'm just thinking Russia particularly, has increased its gold reserves to back its own currency?
It's interesting you mentioned that, because of all large countries in the world today, Russia has by far the largest gold reserves relative to its money supply. In fact, I believe at current prices, gold prices, and current Russian narrow money supply, by narrow, I mean just basic bank deposits, I believe they are backed something like 65%. That is a huge number. It is larger than the amount of backing the United States had for the US dollar under the Bretton Woods system, when the US dollar was explicitly linked to gold. Russia's doing more than backing its currency. Russia's preparing for either a sustained rise in the gold price, and they simply think it's a good investment, and or B, they're preparing for some sort of other international financial crisis.
Gosh, quite worrying on both sides. From what we've said, that gold does well when the economy's not. If Russia and Russia's head of finance it's a woman, isn't she? She's really good, from what I can remember.
She's terrific, Elvira Nabiullina.
Right.
And she studied under a friend of mine, Professor Nanovsky, who has looked at, he's an economic historian as well as a monetary economist. And he is an expert not only on monetary and financial crises, but also monetary and financial reforms. When you fundamentally reform the way a banking system works, when you fundamentally reform the way a monetary system works, Eastern Europe, which is where he is from, of course, has gone through all of that in my lifetime, when they had to rebuild from the complete collapse of the Soviet/Warsaw Pact monetary and financial system. And so, he's an expert on this sort of thing, and she was a student of his, and she knows her stuff.
Yeah, well, I think, I'm surprised to hear myself say this, but, if the head of the Russian finance system says it's a good idea, it probably is. It probably is. Now, I've got another question. It's from Laura, I think it is. And you'd like to know, is there, oh, sorry, I'll ask you in a moment. Is there no, so this is Bruce. Is there a one-off upfront fee or an annual fee to store gold at the Royal Mint? Andy, this is for you.
Yeah, so it's an annual fee against the value of the metal stored in the vault. So it works like a percentage charge that an investment fund would charge you for handling your money for them handling your money on their behalf, basically.
So it's basically it's an ongoing rather than an upfront fee.
Yes, yeah, based on the value of the metal, the total value of the metal stored in the vault.
Okay, so if I've got £1,000 worth, it'll be 1% of £1,000 each year, will it?
Yeah, and that's broadly that's for storing physical metal. Obviously, the DigiGold storage fee is lower than that. It's 0.5%.
Okay. Oh, that's good to know. So now, Laura, you were wondering if the webinar is being recorded. Yes. This webinar is being recorded, and it will be uploaded onto MoneyMagpie with an article attached, and it'll be in our newsletter next Tuesday and in our investing newsletter the Saturday after. So if you haven't been able to hear it properly, and I'm so sorry, and I don't know why that is, something to do with the internet fairies, I think, or Eventbrite's fairies, has meant that it hasn't done terribly well. Now, same question as Morgan. What's the best platform for a beginner to start investing? Charlie, do you have a view? I mean, we're talking investing platforms like AJ Bell, Hargreaves Lansdown, any of those. Are those good platforms to start investing, either in gold funds, gold miners, etc.?
Yeah, they're fine. I think they're well known. I mean, I would avoid your bank. I think. Being brutally honest, whatever platform, I don't know, I can't speak for all the banks, but 9 out of 10 banks have a really crap interface with the stock market. And so just don't bother. I think AJ Bell and Hargreaves, I think AJ Bell is probably better value. It's probably cheaper. But these are perfectly good companies. They're well known. They have a good reputation. And I think that they have pretty good client service. If you don't understand something, you can call them. Yeah, open an account with one of those, get started.
Absolutely.
It's not just gold, it's the whole financial world is suddenly open to you. But, you know, don't randomly press buttons. You know, do your research and learn, have some fun, and get involved.
Absolutely. Oh, good. Yes. Now, somebody's asked how you get our newsletter. Very good question. I'll get Izzy, if you would, Izzy, to put the link, the sign up link for our newsletter into the chat so that people can sign up to the newsletter, because it's brilliant and it's free. Also, I was going to add to what Charlie said, that we do have an article on the website about fund supermarkets, another way to describe them, investing platforms, and, you know, how they work and which ones are good. There are a few, as Charlie says, there are a few that are good. He's mentioned AJ Bell, Hargreaves Lansdown, Interactive Investor, Charles Stanley. Those ones, I think, and Fidelity, of course. But yeah, the problem is, as I said before, it really depends how much you trade, which one is going to be better for you. They're all pretty much of a muchness, but some of them are slightly cheaper if you trade a lot, or slightly cheaper if you don't trade very much. So have a look at our article, if I can find it in time, or if Izzy can find it in time, we'll put it up here. But also I can send an email to everybody after the event with some links in, so I will do that as well. Is there a recommended amount to invest in gold for long-term investments? I'm new to gold and looking to maybe put aside £20 per month for now. Is that worth it? Andy?
Well, we started the webinar talking about what percentage of your total investment fund you should allocate to gold. We're not financial advisors at the Royal Mint. We kind of defer to the World Gold Council, who are the kind of authority on all things gold, and they tally with what John and Charlie were saying earlier. You know, roughly 15% of your portfolio feels like a good percentage of your total investment portfolio to dedicate to gold as a hedge and as a safe haven. And beyond that, really, it's whatever you can afford to build up. And as I've been saying, you know, all the way through, the theme and what we've been really trying to do at the Royal Mint is to make precious metals accessible to everybody, no matter what your requirements are, no matter what your how much money you have to invest. There should be, if you take a look at our website, a product in precious metals to suit everybody. Now, I was saying before, you can buy a physical gold bar from £64 on the Royal Mint website, or you can invest through DigiGold from as little as £25 per month. So there really is something to suit any budgetary requirement.
So if you can up your amount from 20 to 25, or maybe just sort of save it for a bit, and then you can buy £65.
Or you know, silver, as we've been saying as well, is more affordable. Silver's around about £17.70 an ounce, I believe, at the moment. So, you know, there's a Silver Britannia coin, beautiful, iconic coin. Really have a look and see what fits for you.
Yes. Now, Bruce also says, I'm quite keen on silver. What options would you recommend in that market? Well, you've mentioned this Silver Britannia, Andy. John, do you have a view? Charlie was saying that silver is, you know, if you want a bit more excitement in your life, basically, it's a little bit out there, a little bit woo. But what do you think, John, about investing in silver?
Oh, I think it's perfectly legitimate to be investing in silver as well as gold. Silver does tend to be 2 to 3 times as volatile as gold. And so unless you have a very specific view that it's going to outperform, you would probably want to hold considerably less silver than gold so that its risk contribution and diversification contribution to a portfolio are not disproportionate to gold in that portfolio. However, if you look at a ratio of the gold price to the silver price, it's not quite as high as it was for a while. It has come down a bit, but silver still looks undervalued in a longer term historical comparison. And I think that's an opportunity. And I think it's an opportunity because while gold has certain niche industrial uses, silver actually has not only a large set, but a growing set. And some of them are related to medicine and healthcare. Some of them are related to biotech more generally. Some are related to certain aspects of green energy innovation. And I think that when you look at all of that, the industrial demand for silver is only going to continue to increase. And yet, A lot of silver mines in the world are currently not even operating because silver isn't expensive enough to make it economic to operate those mines. And you'd have to have a very considerable rise in the price of silver for those mines to restart production, which would then potentially begin to put a cap on the price. So I think with, to the extent you want to take a view, I actually think silver is likely to outperform gold at least a little bit over the coming years.
Jasmine, can I just very quickly drop in and say, let's not forget about platinum either. It's the rarest of the three metals. It fits in between gold and silver in terms of affordability levels, used in a lot of industrial technology, increasingly in green technology. So let's not overlook platinum as well.
Well, that's good. Bruce says, yes, he would like more excitement in his life. So silver and platinum, Bruce, that's clearly the exciting thing. And maybe we'll talk another time, Bruce, about other ways to bring excitement into your life. MoneyMagpie is definitely the place. Now, we are getting a few more questions. Now, this is Rebecca. What are your thoughts on gold versus Bitcoin? Charlie, are you still there? What are would you say are the differences, or what's the pros and cons between gold and Bitcoin as an investment?
Some of them are really, really obvious. So we'll very touch on them. One's virtual. There's a bunch of numbers. Clever numbers, big maths backing it all up, and all that. And the other one's physical and dense and shiny. So you've got that obvious difference. But economically, on the supply side, they're the same. Satoshi Nakamoto designed Bitcoin around the idea of gold. So he wanted to have a falling inflation rate, new supply each year, limited supply of 21 million. Currently, the inflation rate, if you will, on both gold and Bitcoin is about 2% per year. So increase in production is about 2%. And that's dropping off in both cases over the year, tending towards 0. Depending on your outlook for gold mining, but essentially they're both deemed to be hard assets because there's a limited amount of them. But that's when the similarities end. On the demand side, they're completely different. And gold is widely accepted. All the gold in the world's $12 trillion. All the Bitcoin in the world's $1 trillion. Yeah. So you've got 12 times market differential. And that's assuming lots of Bitcoin hasn't been lost, which of course it has. So there's some assumptions in there. If you owned all the Bitcoin, Jasmine, would you be really clever or really stupid? Which one are you?
Well, I think you'd be really stupid because nobody else would be able to trade with you.
Bang on. So if you owned all the gold, that might be a bit cleverer. Then you could be Cretius.
Yes.
So if you own, it's like owning all the Bitcoin is like owning all the telephones. You've got no one to call. The value's in the network. It's not in the Bitcoin itself. Yeah. So you're buying a share in the network, a de facto share in the network. And so the most valuable Bitcoin could possibly be is the whole world's population own some and use it vigorously all the time. That's the most valuable you could ever make Bitcoin. With gold, do you really need to shove it in every corner of the earth and having it whizzing around back and forth? No, it's just gold. It's about the physical asset. So there's a big difference there. And that comes through in the demand. And, we were talking earlier about gold responding to financial repression, this idea of inflation and low interest rates. That's an environment that gold really works in. The central banks like Russia and Turkey and others, they own gold. So they're established players in the market. They're not in the Bitcoin market. But the Bitcoin market has got a big exposure on the internet, which, by the way, is a fast growing way to get hold of, millions of young people, adventurous people around the world. You can make borderless instantaneous payments. So, I'm not more excited by one or the other. I think they're both very different, very exciting assets, and they're both very different assets. So my argument would be that own gold and Bitcoin, and the ratio between them, very, very simply, would be approximately 3/4 gold because it's less risky, and 1/4 Bitcoin. Yeah, you could make it 1/5 Bitcoin. I think going below 1/5, you're starting to not have enough. But go much above 40% Bitcoin, then there's not much point having gold. You may as well just go all in at that point. Yeah, so sort of a third, a quarter Bitcoin, something like that. And then gold, and rebalance periodically, every month, quarter, year, whatever you tickle. And by the way, if you want to know what is Bitcoin and gold, it's called bold. So you invest in gold, and that's the way forward. I think it's a fantastic concept.
That's really good. I think we'll have to do an article on investing in bold.
You too.
Well, we've come to the end of our webinar now. Thank you so much to Andy Dickey from the Royal Mint, to economic historian John Butler, author of this book, The Golden Revolution Revisited, and to Charlie Morris from ByteTree Asset Management. Now, remember, nothing that has been said in the last hour has been financial advice. We are not financial advisors. You do your own research and get your own information, and speak to a financial advisor if you would like actual advice.